In this video, I will show you how to use the balance sheet data in order to perform a fundamental analysis for a listed company. We will use Nvidia and Microsoft as an example, but of course you can use the same method on all the other companies listed all across the globe.
So thanks to the fundamental analysis, what we try to do is understanding if the company is doing good and if the company is over or undervaluated. So in this case, for example, talking about Nvidia, we have three different layers, okay? We have the visual layer where we can find chart regarding the company results, okay? We can find the raw layer where we have all the numbers for the income statement, the balance sheet, the cash flow, both annually and quarterly, okay? And we have the transcription. Every 3 months, when the company release their results, the management is telling something, they comment the results, and here you have all the transcription for every quarter, okay? Of course, you can read it and instead of watching a film with your wife, you can stay all the night long reading all the quarterly, all the transcription. But we did something interesting because we added to the Forecaster terminal the AI agent, and in this case, just clicking the button, you can ask the AI agent to give you a resume for all the transcription, and you will have the positive news, the negative news, the risk and concern, which is a very important voice because the management must tell you which are the risk and concern they see for the future, and of course the future outlook, the notable information, and everything you need to know about what the management said. You can also do the same in the raw page where you can ask the AI agent to analyze the income statement and the balance sheet, okay? And we teached to our AI agent to analyze the data. And this is something very important because as today we use the calculator for doing our math, now we can also use the artificial intelligence to analyze income statement and balance sheet. Okay, let's go back to the visual part, which is which is very interesting because here we can see the financial, and we can definitely see in a fingertip how the company is performing. Okay, so in this case we see that the company is growing both on sales and net income. Okay, we can see also the quarterly. Okay, and we can also see both on annual and quarterly the ratios. What ratios are? Something really easy. We have the profit margin, the ROI, and the debt equity. Profit margin is very simple. Of course, you have all the explanation here. I would like you to remember that the forecaster terminal aim is not to be a black box, but we really would like you to understand the data you're watching, because you have to trust the data you're watching. And if you don't understand from where they are coming from, you cannot trust the data. So every time you see something, we explain to you how we add this result and what is it. Okay, so in the case of Nvidia, here we have a very high profit margin, 64%. It means that every $100 of sales, 64 become earnings, which is an amazing result. ROI, very interesting, return on equity. We can see the ROI, return on equity measure, how much profit a company makes compared to the money its owner, the shareholder, have invested in the company. Okay, very important number. And of course, the debt equity. This is the number of debt compared to the equity, which are the money the shareholder put it in the company. If it's below 1, it means the company has more equity than debt. That in general is a good news. Okay, of course, we have many years and we have also the quarterly, because it's very important not only watching a single year, but it's important to watch the trend of the ratios. We have to watch both the trend of financial and ratios in order to understand which is the trend of the results. And this is very important. Thanks to the trend of the result, we can calculate the fair value, which is, in the case of Forecaster, an average of 3 different approaches. We have the discounted cash flow, the Peter Lynch method, and the economic value added. Why we use 3 different approaches and not only one? Very simple. I show you something. As always, we didn't invent nothing regarding this type of evaluation, but these are methods that you can learn if you go to the economic university. Um, why we use 3 different calculation and not only one? Because of course these different methods target different parts of the income statement and the balance sheet, and we can have a more resilient result if we use different approach and we use different method that target different part of the income statement and the balance sheet. Okay, I always do an example. How can you, for example, um, evaluate 2 different person, completely different person, like Usain Bolt and Woody Allen? Of course, you cannot evaluate them with a single method, because if you evaluate Usain Bolt for his velocity, probably he, he will have a much higher valuation than Woody Allen, which in velocity probably, I don't know him personally, but I really think he is not fast as Usain Bolt. Okay, so this is why we use different method, because of course we are approaching many companies inside the forecaster, and if we use only one method, we can maybe we can maybe evaluate Woody Allen with something that it's not that doesn't fit him. Okay, so in this case, for example, we evaluated Usain Bolt 100 on 100 regarding the velocity, 10 on 100 regarding the creativity. Of course, it's just an example. Age 37 on 100, so the average is 49. Okay, and regarding for example, Woody Allen, we have 1 on 100 in velocity, 90 on 100 in creativity, and age 88. Okay, so we have an average result of 59. This is just an example to let you understand why we use 3 different approaches, and it's important we don't put any type of biases inside this calculation. What we use in order to calculate the fair value are exactly the original formula for every single method. Okay, and this is what we do. For example, the Peter Lynch method, if you would like to deep dive fair value formula, here it is. It's very simple. It's earning per share multiplied by the earning per share growth rate. Okay, so we have all the data, we have as you can see, the growth rate for the net income, okay? And that's it. This is all the data we use for calculating the over and undervaluation. Of course, this is not enough, because when you would like to understand if a company is good or not, you don't have only to watch the financials or the ratios or the fair value. You have to understand if the company is solid. And this is why we created the solidity part for the fundamental layer. And here we have three different scores that are really important. The first one is the Altman Z score, is an amazing score that tell us if the company has a risk of bankruptcy. Also in this case, we have a public formula. You can go on the internet and you can find here it is, okay, and the foretell the in a safe is in a great zone or has a risk of bankruptcy in the case the result is less than 1.81. Okay, of course, in the case of Nvidia, we do not have a risk of bankruptcy. We have a very high Altman Z score. Piotrowski score is another very interesting ratio made by Piotrowski, which is a professor of a very important university. Also in this case, we have different number. We have also in this case a very simple formula, okay, that you can of course find online, but I can show you better here, okay. The results is a number between 0 and 9. Of course, if you find a company with 6, 7, 8, or 9, it's considered a strong company. How you can calculate this number is very easy, because you take 1, 2, 3, 4, 5, 6, 7, 8, 9 ratios, which are, for example, the net income. If the net income is positive compared to the previous one, you add 1 point. The same for operating cash flow, the same for return on asset, the same the quality of earnings. If you have a positive ratio compared to the previous one, you add just 1 point. At the end of the day, if you have 9, it means that you have a better situation compared to the previous one, okay, and you have a solid company. This ratio is very interesting, because this is a study from Société Générale, a very important European bank. And as you can see, they divided all the company from US, Europe, UK, and Japan in groups. Company with a Piotrowski F score of 1, Piotrowski F score of 2, Piotrowski F score of 3, 4, 5, 6, 7, 8, 9. And they realized that if you buy only companies with a Piotrowski score of 9, you overperform the average of the market. And the same happen at the opposite side. If you buy only company with a Piotrowski score of 1, which means it's not performing well, fundamentally speaking, a group of shares made of only Piotrowski score, very low Piotrowski score, it will underperform the market. And this is a very interesting metric that tell you just in a very quick, very quickly, if the company is doing good or not. And this is why we plotted not only 1 year, but of course the trend. Look, the trend for NVIDIA is very nice. Benisham score is another really nice indicator, another ratio, very important, because it tells us if the company is unlikely to be manipulating its earnings. Okay, this is a very popular ratios, because I don't know how old you are, but if you go back in 98, students from Cornell University, they applied the Banish model and they unveiled the dark truth behind the Aero Corporation facade. And this is something really interesting, because this is the formula. It's a little bit complicated, but of course you have the formula. It tells us if something bad has been done with the numbers inside the income statement and balance sheet. Okay, and um, as uh, as you can see in the past, this ratio helped to find many fraud, like for example the Wirecard manipulations has been made in 2020. Okay, and as Dr. Lee say, a professor at University of Washington, a rising combined score from 8 specific metrics suggesting a company is growing but also losing its core business strength and could be engaging in aggressive accounting. Even if legal, because of course we don't, this is not a proof that they are doing something illegal, but if they are doing something like that, if they are doing an aggressive um, an aggressive accounting, it's better to avoid these kind of companies, because they could have problems in the long run. Okay, so these are 3 ratios very important to analyze the solidity of a company. If the company is solid enough, we can go deeper and we can analyze the value generation, which is another uh, chapter inside the fundamental layer. And here we have a very nice parameter, which is the shares outstanding. Very important, because this is the number of shares that are on the market. And if the number decrease, it's something really good for us investors, because the value, the intrinsic value of all the other shares that remain on the market tend to grow. Okay, I have a very quick example here for let you understand what is the share repurchasing. For example, if we have a bottle of 1 liter of water and we divide this water in 4 glasses, we have of course 0.25 liter for every glasses. Okay, if we take the same liter of water and we divide it in 5 glasses instead of 4, we have of course 0.20. Okay, and this is something really interesting, because sometimes it happens when that the company is doing great as results, as financials, but on the stock market the company doesn't grow. Okay, and probably it's something that happens when the company is doing good, but it's also issuing more and more shares. Okay, which is something you can do if the company is doing really great, but as Nvidia is doing since 2022, it's better to repurchasing shares, because what's happening if you're repurchasing shares, the value, the same liter, if you divide the same liter of water in 3 glasses and not 4, you have 0.33 liter for every glass. Okay, so if we go from this situation to this situation, very simple. Of course, we can do the same example with shares. If you have a company which worth 1 billion and you have 4 shareholder, you have 250 million for every share. Okay, if you add one share, the value of the company remain the same, but of course the value of all the other shares drop at 200 million. The opposite happen if you have the company which still value 1 billion and you take away one share from the market, the value of the free shares that remain on the market goes up until and reach 330 million. This is why it's very important to have a look to the number of shares, because in general, what if a company is repurchasing her own shares frequently, it's something that allow the prices of the stock to go up constantly. For example, here we are on Apple, and Apple is doing buyback since ever. Okay, here we are on Meta, and Meta is doing buyback since ever. Okay, it's a sign. Doing a buyback, repurchasing all own stocks is a sign the company, the management think that the company is undervalued. Look, for example, we have ASML, which is a very important company that makes chips, make not chips, but machines that makes chips. If you go here to the fundamentals, look what they just did. They just repurchasing lot of shares because the shares went down a lot, and they really think the company is undervalued, and this is why they repurchased a lot of shares. Look, for example, here what we said at the beginning of this lesson. Look, this is a very nice example of a company which is going down because of tariffs, but the results are growing because this is the only company that create special kind of machines for creating chips. And look, results are really going up and the prices are going down. This is a very huge opportunity, and I recently bought shares for this company, which is an amazing company. Okay, and I have the confirmation that this company is amazing, because if we look the fundamentals and we look the share repurchasing, we can definitely see that the management is aggressively repurchasing their own shares. Okay, because look, they did something great because the price is very low. As Warren Buffett said, when you are told that all repurchases are harmful for shareholders or to the country, or particularly beneficial to CEOs, you are listening to an economic illiterate. Okay, and this is Warren Buffett talking about repurchasing buyback program. Okay, buybacks are always good, and this is why we can see the buyback trend here on the Forecaster terminal. Look at Microsoft, for example. They are repurchasing since ever. Okay, another interesting voice is the shareholder yield. Okay, if you are looking, for example, to a company, here we are on Microsoft, of course you have a dividend yield. This is the yield you get if you buy shares of the company, okay, just from the dividend. Of course, everything is explained. Shareholders yield is very interesting because you add to the dividend yield the net buyback yield and the debt pay down yield. It's very interesting because especially if you're looking for a company for the long run, to invest in a company for the long run, you really understand, thanks to the shareholder yield, from where the dividend is coming from, okay? Because if you have a shareholder yield which is higher than the dividend yield, it means that the dividend you are getting from the company really is coming from good result. Because if you have, for example, a shareholder yield which is lower than the dividend yield, it means that the company probably is doing debt in order to pay you a dividend. And this is something that sometimes happens to companies, but it's something really bad because it means they are using your own money in order to pay to you a dividend. Okay, so this is a very important metric, the shareholder yield, because it tells us if the company is doing is paying for real is a shareholder or not. Okay, here on the right we have the weighted financial, which are very interesting numbers, because you have the sales compared to the number of shares, the net income compared to the number of shares, the free cash flow compared to the number of shares, and the gross profit. Like in this case, all these numbers are growing. It means that the company years by years is becoming more efficient. Okay, and this is a very important ratio. These are very important ratios because you really understand if the company is getting better year by year. Okay, avoid companies that has this ratio going down, because it means they are not improving their efficiency. Okay, and of course here you have um, a, a resume of all these ratios. In this case, you have a shareholding yield which is decreasing. Okay, so it's not the best situation, but of course you have go deeper to the analysis. Let's go, for example, here. Here we have a shareholder yield for Meta which is increasing. Everything is good, and this is why the company is valuated robust. Okay, in the case of Microsoft, the company is resilient, which is of course good because his here is in green, so it's good, but robust, of course, it's better. Okay, the last so in this case, guys, talking about Nvidia or Microsoft, let's talk about Nvidia, which is the example we would like to make. As I told you, first of all, we can see the under overvaluation. In this case, we have an undervaluation of 62%, which is very interesting. We have a company which is very solid, okay, with an Altman Z score of 54, incredible. Piotrowski score is good. Benichem score is minus 2.28, which is good. The company is doing great as per efficiency. Look how it's growing. And they also doing buybacks since 2022. Really nice, amazing company. Okay. Fundamentally speaking, we are talking about a company which is nice, which has an upside potential. And so we can definitely say we find also in the fundamental layer the same situation we saw in the overview, in the seasonality, in the overbought, oversold. Okay, of course you can deep dive inside the analysis. You can, as I told you, use the AI Forecaster AI agent that give you a deep analysis of the income statement, the balance sheet, and everything. And this is very interesting also for the transcription because, as I told you, at the moment there are many people inside the banks that are doing the analysis, especially young people, but in month or year, this kind of job will be something like the calculator. Today, everybody are using the calculator, and it's stupid not to use the calculator because I mean, it would be stupid not to use it, okay? And the same is with the artificial intelligence. We teach how to use the artificial intelligence, how to do this kind of analysis to artificial intelligence, and it's better than us to make resume of papers and papers and papers, and this is very nice, and you can pick something interesting inside all these numbers and all this data in order to understand if the company has a very strong potential for the future. Talking about the transcription here, what is very important is this voice, risk and concern, okay, and future outlook. Here you can definitely see if something bad is in the eye of the management, okay? So always go to the transcript and watch and listen what the management is saying about the risk and concern and the future outlook. Very, very important. If you would like to do a complete analysis of every stock, it's very interesting to do the full analysis. And especially in this case, what is very interesting is the competitive advantage analysis. This is something that was invented by Warren Buffett, the moat analysis, okay? And the artificial intelligence in this case give you a rating for the moat that in the case of NVIDIA is 9 on 10, which is very high. And this is very interesting because the competitive advantage is telling us something really interesting about the company we are analyzing. And it's very important to understand what kind of company we are analyzing.
This video is an extract of an entire masterclass regarding investments and trading. You can find the entire free course here on YouTube. You can find the link in the description.